My name is Justin Smith, and I've been educating thousands of people about the risk and the tax mitigation when it comes to their finances. Also, I've also been helping people prepare for a safe and a comfortable retirement. In this episode, I'm going to teach you how to do exactly what the banks are doing and earn rates of returns of anywhere between 100 to 500%. And of course, we're going to talk about my favorite tool, which I like to call the Smith Fund, which has predictable returns of doubling your money every 7 years, according to the 40 years of history that we have on this product. So I'm going to show you the concept of safe positive leverage, which means that we have the ability to control our assets with very little, if not any money tied up in the asset. One quote that I can't get out of my head lately is leverage without liquidity is actually stupidity. So by the end of this, you'll be able to do what banks do. This means you can borrow your own money at a much lower rate while still gaining that 100%, if not more, on the money that you have inside these policies. Like I said before, this can be used for your business. This could be used to buy businesses. This could be used for real estate. A lot of things that you can do, even paying off your expenses. You will also be able to accumulate millions of dollars. If you do this concept for 15, 20, 30 years, you'll easily be at 7, even 8 figures just by becoming your own bank. So let's start by what do banks actually do and what does insurance companies actually do that has a multi-trillion dollars in liquid assets. What do they do? These are the backbones of America. Let's take it back to the 80s. Back when there was a big real estate drop where they dropped nearly 80%. Not to mention, 40% of banks closed and never reopened again. Legal reserve insurance companies came out better than ever, if not even better than, way better than before the Great Depression even happened. This is because they have reserves on hand that are very liquid, just in case people want to make a run for their institution. So in 2008, because of the mortgage meltdown, over 400 banks went under. And even 900 banks were on the watch list, which was really scary to the government. A lot of Americans did not realize how close we were to a financial collapse in 2008. Then the federal government asked the top 5 banks, they said, hey, where are you guys putting your tier 1 liquid assets? Could you guess where it was hiding? They were hiding in insurance companies. Insurance companies were crediting them anywhere between 4 and 5% in 2008. So this means in 2008, banks were borrowing other people's money, or what we like to call OPM. This means when you put your money in the bank, or if you were to put your money in the bank in 2008, that money is now in a lending position for other people or other businesses. We all know banks don't pay as much in interest because they're loaning it back. They say they're investing it, but they're putting about 30 or 40% of that money into insurance companies because they're bigger and they're stronger. Some of these insurance companies where I'm starting to put my money are managing over trillions of dollars. As a matter of fact, there's one insurance company that's collecting as much money as the IRS collects in 1 year. That's trillions of dollars. That's crazy. Now, this is where many governments go when they need help. When they need it, they'll go to the insurance companies that have trillions of dollars. So now I'm able to bypass the banks and put my money where the banks are putting their money. These banks were paying less than 1%. In 2008, these banks turned around and put millions of dollars into insurance companies and they were earning 5% back. Now, for you math wizards out there, if I were to ask you how much is 5 more than 1, please don't say 4. It's 500%. That means 5 times. That means they're paying $10,000 and earning $50K on that money. I mean, wouldn't we all like to hire an employee right now and pay him 10 racks and get $50,000 back? That's a 500% return. Business owners get this. So this is what banks and credit unions do. And so now this is what you can do. Yes, you can do this. So my favorite tool to do this with is a max funded index universal life insurance contract, or what I like to call the Smith Fund. In other episodes on this YouTube channel, I talk about how we want to put the smallest amount of insurance into a contract, but be able to fund it the most amount that we can, or that the IRS allows us to, so we can get tax-free cash. This same tool has allowed people to earn an average of 10%. Now, 10% does not compare to those quick investment tools that you see these days, but over a long time, 10% beats anything. I mean, you can rent out an Airbnb for $7,000 a month, which is like $350 a night, and let's say your rent or your mortgage is $2,000, that means you just socked away 5 racks and you can make $1 million off of that. So let's take that snapshot in time, and now let's say you have $1 million into your Smith fund, your max funded index universal life contract. Now here's what savvy business owners do. They operate as their own banker. So lock in with me. Let's say you have $1 million and now you see an opportunity. You know, most people or some people would use those funds to invest in real estate. So let's use that for an example. Let's say you look for multifamily complexes that the seller just wants out. Doesn't want to repair, doesn't want to refurbish them. They just want to get out of that. Like I said, they just want to get out of it. They don't want to chase down tenants. They don't want to do any fixing toilets. They're tired of it. So let's say you like to just fix and flip. You don't like to be the landlord. So you fix up the property. You also have a pool of investors that are ready to just get that cash flow coming in. So then you find a good property, and that property may be $10, $15 million. But most properties need earnest money. So at that point, what you say is, you bring my phone, shoot me an email, shoot me a text. Hey, Justin, I want to put my $1 million into this property and get it tied up into this property. I need you to send me that form. I email you the form. You have the Smith Fund, your IUL policy. You put your name and your policy number at the top, just like an account number. Then it would ask you, would you like to borrow $1 million or would you like to withdraw the $1 million? And if you see my previous videos, obviously I would tell you to borrow the $1 million, because if you withdraw the money, you have $1 million of earnest money on the property. There's nothing wrong with that. You know, you got the property now and you don't have to pay taxes. But if you're a business owner, savvy minded, you would borrow. Now you may be wondering, Justin, why would I borrow my own money? What's that gonna do for me? Because there's 2 ways you can borrow. The first way is a zero cost loan or a zero wash loan. You'll be able to tell the insurance company, hey, I think we're going into a recession, so I would like to borrow my money. Now, in order for it to be tax-free, the insurance company will have to at least charge you a nominal interest rate. So let's just say it's 2%. So the insurance company will charge him 20 grand. He don't got to write a check for it, and it's not payable or due payable during your lifetime, because the insurance company is crediting the collateral of that $1 million in that policy 2%. So you borrow at 2%, you're making 2%. So that makes it a zero wash loan. And since you're calling it a borrow, it makes it tax-free as well. Usually what I would do is suggest an index loan. But what is an index loan? I don't think y'all ready for this one. So make sure you follow, hit that like button, follow this channel. This is just a little piece of why it's worth it when it comes to becoming your own bank. So let's say you go for the index loan and they're charging 4, maybe 5% on that loan. Now, why would I want to be charged 4, 5% on my money when you just told me I can get 2% or even just wash it out completely? Because since it was $1 million of collateral on that policy, you didn't withdraw it, you borrowed it, meaning it's still as collateral in the policy as $1 million. So basically now you're saying is, okay, charge me 5% on that $1 million, but I'm still gonna use that $1 million and go make 2, 3, 4, 5 million with that money. This is how rich, savvy people accumulate millions of extra dollars by accumulating their Smith Fund, their IUL, tax-free by becoming their own bank. It shouldn't really matter if you're borrowing at 5%, but you're guaranteed to make 10%. Like, what's 10 more than 5? That's 100%. Like, would you hire someone for $50,000 if they're guaranteed to make you $100,000? I'm sure me and you both would do that any day. Now, lately, the average has been earning 100% more than the cost of loaning from these policies. Some years you may not be up, but other years you may gain all the way up to 15%. Keep that in mind. Now, if this is something that interests you, if this is something you're like, Justin, I gotta get my hands on, check the link in the bio, check the link in the description right now. I have an ebook for you called The Smith Fund. It's 10 to 15 quick pages that gives you step-by-step, start to finish, foundation on why you should become your own bank and why this is something you need for your future, your family, and your goals. We'll see you next video. My name is Justin Smith. This is the Investments YouTube channel. Peace.